Welcome to another video. Today we will be speaking about how you're supposed to structure your trading plan. We will be taking my trading plan, so the one that we use with the students to trade the market every day, and we will be analyzing it and seeing how you're supposed to do it from a reactive perspective and not predictive. So how to have a clear set of rules to follow when you're trading the market, and how it will actually help you to become absolutely consistent in the market because you're following rules instead of following emotions. So let's get straight in the video and provide this free, valuable content to all of you. Okay, so this is how the structure of our trading plan is. So basically what we do, we take our direction from the monthly, weekly and daily time frame. That is very, very important, because if you take a direction from higher time frames, then what you're able to do on lower time frames is you're able to take your trades with a reduced stop, but you will have a target from higher time frames. And this is what basically it translates in is having a very, very high risk to reward ratio. And the reason for this is that on the 4-hour time frame, you will be able to take an entry that it basically is precise. So you have a precise stop, basically relatively close to your entry because it's protected by the structure on the 4-hour time frame, and your overall target is at the completion of the higher time frame move. And how you do this is basically by knowing the patterns that you have on the monthly, weekly, and daily time frame. That is basically what you're supposed to focus on, which are the patterns on the monthly, on the weekly, and on the daily time frame, and how they basically combine with each other on the multiple time frames, and also basically which are the moves, okay? Where do the patterns complete? And those will basically be your targets from higher time frames. And then what we do, basically, we also combine this with the COT data, which is basically the way in which hedge funds are positioned in the market, because this gives you an edge basically, and helps you understand, are they actually willing to make this pattern complete? Are they actually, for example, if you have a bullish ICI, so we know from higher time frames that the market is supposed to make a push to the upside, then we will go and see, okay, but are they actually buying? Okay. And the reason for many people think that COT, okay, you get basically you're getting this data with a little bit of a delay, so it might not be precise. But the truth is that they have so much money to basically manage this. Hedge funds have so much money to manage that basically what happens is that they take time. It takes a lot of time for them to actually complete their shift, for example, from sells to buys. So basically it takes a lot of weeks for them to close their positions and open new positions, because there isn't the liquidity in the market to actually make those moves happen right away. So that is why you see all this retests. You basically see the market retest in area multiple times. That is because they basically need to keep just filling in the orders. People that are trading lower time frames see the moves to the upside and they start buying. But if that is a resistance level that they want to respect, for example, for another push to the downside, then they will use the orders that these people are bringing, these buy orders, to actually fill in their sell orders. So you need to take your direction from monthly, weekly, and daily time frame by knowing which are the patterns in the market. So what I suggest to you, if you don't want to join the mentorship program, is to focus on which are the patterns that repeat over and over in the market, basically in repeating the market in a predictable way, okay, with predictable moves and targets. And that is what you will use as a target in the market. And that is why, as we see here, the target is from monthly, weekly, and daily. For what regards COT reports, what I suggest to all of you is basically you need also the historical reports, okay? You just can't look at the last report. You need to use also the old reports and see how basically the market evolved, how their orders are evolving over time. Because as I said before, it will take time for them to actually shift all their orders from buy to sells or the other side around. The entry is always taken on the 4-hour time frame for our swing trades. Now, why the 4-hour time frame and not lower time frames? For a very simple reason. The 4-hour time frame is extremely simple to analyze, and it basically factors out most of the noise that you have in the market. So basically, every time that you see the market, for example, do all those crazy moves on the 1-hour time frame, 15 minutes that you guys are looking at, you will not see that on the 4 hours. On the 4 hours, everything will be extremely easy to read. You already know the direction from higher time frames. You're just using the 4-hour time frame for your entry. So you need to know how the structure works basically on the 4-hour time frame. If you're able to master the structure on the 4-hour time frame, and you're on the 4-hour time frame already knowing which is the overall direction of the market, you will be able to use the 4-hour time frame to actually take your entry. I will now show you also a live example of that. So the entry is taken on the 4-hour time frame, and yes, on the monthly, weekly, and daily, we have different strategies that give different patterns that have different directions. So we have a different way with the strategies that we use for, so the TL strategy, the ICI strategy, the WM strategy. We do use different patterns for the direction, but the entry criteria are always the same, because on the 4 hours is the 4 hours. Okay, that is how the structure works on the 4 hours, and that is how you can use that structure to actually take your positions. And also the trade, basically when you have to manage your trade, you do that on the 4-hour time frame. Why? For the simple fact that you can decide when to go risk-free by using the structure on the 4-hour time frame to protect your stop loss. Okay, so you manage your position on the 4-hour time frame, and the risk management again is the same. Okay, so when it comes to direction and targets, you will have different strategies to take the direction, different patterns that the market creates on higher time frames that will give you the direction. But when it comes to entry, it's always the same. Entry criteria is always the same way to manage the trade and the risk. And obviously, yes, the same way in which you manage the risk. So for example, for us, it's minimum 1 to 3 risk to reward and 1% risk per trade. You can also increase the risk per trade, but overall it's supposed to be standard is 1%. But with a 1 to 3 minimum, why it's so important to have a 1 to 3 minimum? It's so important because it's the basis of basically any profitable strategy. If you're able to position yourself in the market with a 1 to 3 risk to reward, even if you're right 3 times out of 10, you're still in profit. Okay, if you win 3 trades out of 10, so 3 wins with a 1 to 3 risk to reward and a 1% risk per trade will equal, you win 3 trades, so 3 times 3 will be 9%. So you made 9% winning 3 trades, but you lost 7 trades. So basically minus 7%. Okay, so overall, you are still in profit 2%, and you only were right 3 times out of 10. So very low, basically win rate. So that is the reason for which we have 1 to 3 minimum. But if you do this on high numbers, basically, because it can happen. You can lose 5 trades in a row, but this doesn't mean that your strategy is not profitable. That is why it's extremely important, after you have defined your trading plan in this fashion, which patterns do you trade, that I can't tell you that, but I can tell you the structure of our plan. Once you have determined your entry criteria, your direction criteria, your risk management, when do you go risk free, how much you risk, which is your minimum risk to reward, then you have to test all of that, back test it and live test it to prove that it's actually profitable. Because then when you will have a losing streak, for example, you lose 5 trades in a row, if you know that your strategy is tested and proven profitable, you will just keep applying the same rules over and over again, because you know that on a large number of trades, there is no way that you will not be in profit. And that is basically the biggest reason for which basically people just keep losing in the market, because the simple fact is that they go in the circle of doom, is called, when they basically lose few trades and they just keep tweaking their strategy and changing from strategy to strategy, ending up in the end to the same strategy at the beginning. And basically this is just the best way to never become profitable in the market. So that is why it's extremely important to test it, because if you test it, you will not do this. You will just keep applying the strategy and your account will keep growing and growing, because using big numbers, you know that overall you will be in profit. So you will just keep applying the rules over and over again. So let me just give you a live example, quick live example of basically how you can use these concepts, okay? First taking the direction on higher time frames and then using the entry on lower time frames to basically actually trade. So let's review a trade that we took with the students few weeks ago, and let's see what we had. So from a monthly perspective, okay, from the monthly time frame, what do we have? From the monthly, we have a clear pattern here, okay? This candle here, when you see a candle that has this shape here, so a big wick and a body list like this, or also if you see the same candle, okay, and you can go on the chart and see it with your own eyes and test it. Most of the times when you will see a candle that has either this shape to the upside or this shape to the downside, if you have this on the monthly, weekly or daily time frame, the next candle will fill in the wick, okay, will go to fill in the wick. And the reason for this is that if you have this wick will only be a retracement on the lower time frames. For example, if you have this candle on the monthly, on the weekly, the wick will only indicate the retracement that you have from a weekly perspective. And in fact, basically from the monthly, we knew that the market had this candle, and we also knew that we had a support area here. So overall, this tells us that from here, we want to see a push to the upside. Then we go down on the weekly time frame, and on the weekly, what do we see? We see a market that has created a nice impulse to the upside and already started a retracement. And how do we know that this is an impulse and it's not a retracement of the bigger move? For the simple fact that you can check how strong a move is by meeting in relation the two different the shapes and the sizes of the candles. In fact, what you can clearly see here is that with only two green candles, with these two green candles, the market took out 1, 2, 3, and 4 previous candles to the downside, meaning that if a retracement, that this was supposed to be a retracement, is stronger than the impulse to the downside, it means that this is not a retracement. This is a new impulse, and the next move is not the continuation of the original impulse, but it's basically a retracement of this push to the upside. So we expect the market to make another push to the upside and complete this W formation, going for a retest of the previous support, now turned resistance, which is something that we expected from the very beginning, because in an ideal downtrend, you will have a market that goes to retest previous support, turn resistance over and over again. This is just something that you expect from the beginning. So also another thing that we did, we took our Fibonacci obviously on the impulse, so from the low to the high. Let me bring back all the Fibonacci levels. And what you can clearly see is that overall the golden ratio had already tested. The market was in between the Fibonacci levels, so it was supposed to start the next push to the upside from this area basically. Going down on the daily time frame, what you had was further confirmation for the push to the upside, given that overall the market had created basically this M formation. But on the daily time frame, the environment of the market was still bearish at the moment, because from a structural perspective at least, because the market had created an impulse correction and was starting another impulse to the downside. So basically on the daily time frame, we had to wait for the market to give us a clear sign that it was ready from a daily perspective to make a push to the upside. And this is exactly the moment in which we had our confirmation from a daily perspective. Why? For the simple fact that you can clearly see that we had our area of previous support, now turn resistance, tried to make another impulse from the double bottom and closed back above the area. You can see by going down on the line chart, you can clearly see that overall the market closed back above the structure. You can see. So going down at that point on the 4-hour time frame, before going on the 4-hour time frame, I will show you exactly how to take your target in this situation. Now for us, this was a clear pattern that we trade, a clear strategy that we trade. And for this pattern, the target is basically taken by taking our Fibonacci from the low to the high. I'll bring back the levels. For this kind of pattern, our target is taken by taking our Fibonacci from the low to the high. Why from the low to the high? Because when we want information on this retracement, we took our Fibonacci on the impulse. But now that we want information on the next impulse, we need to take our Fibonacci on the retracement. That will give us two targets, the -27 and the -0.618. And basically, what you can clearly see is that the -27 is lining up with the previous support now turned resistance. And this is not something that surprises me, because in the market everything will connect over and over again. So going down on the 4-hour time frame at this point, already knowing that our target is at the -27, so at this area here, you already know basically what you are looking at from a 4-hour perspective. Okay, let me bring back the level here. Basically, let me show this. Let me make this invisible so we can see it also on the weekly and identify our target. So basically our target is here. Let me delete this one. And at this point, what we can do, we can go on the 4-hour time frame and look for our entry. And this was the moment in which we entered the position, okay, on the retest of this counter trend line and of the cluster of the Fibonacci's that were in perfect confluence also with other rules that I cannot speak about, because we weren't looking for a long, for example, here, because the environment of the market, even if from a structure perspective, the market had already shifted to the upside, from an environment perspective, the market was still bearish and the banks were not buying. And this is the moment basically in which exactly with this candle here, I can't tell you why, it is not on chart. We have other ways to basically determine the environment of the market. At the moment, the market hadn't shifted environment yet. But after this candle, the market has shifted environment and we could take our buy limit here. And this was the biggest risk reward trade of 2019. We had a 1 to 6.8 risk reward on this trade. Now, if you ask yourself, how were we able to actually take a 1 to 6.8% or R, because you don't know how much you risk per trade on a trade, how do we make such a massive risk to reward? It all comes down to being able and knowing how to take the direction from higher time frames and using the lower time frames, aka the 4-hour time frame, to actually take your entry and stop loss.
If you enjoyed the video, make sure you smash the like button and also comment below and let me know. It really does support the creation of more free analysis and education for all of you. Also, make sure you go check out the mentorship program. It's the best program you will get, because first you get all the rules of my strategies and then you trade them with me every day and you have me answering your questions every day. I believe in work ethic over show off, so I'm always there for my students. I've been making Q&A sessions also on the Christmas night, okay? So just to make you understand the commitment that I have to my teachings. So make sure you go check it out. And if not, make sure you go check out the next video.